How does regulation keep you safe from the risk of financial harm? Don't worry, this isn't going to be some nerdy video about the ins and outs of financial services regulation, as well as reporting on some of the steps the Financial Conduct Authority, the FCA, has taken in the past year to keep you safe from financial harm. I'm going to share with you 6 scam warning signs that you need to know in order to avoid being ripped off by investment fraudsters. You really do need to know these because, as you'll hear in just a moment, these nasty investment scammers are literally at every single turn right now. Stay tuned. In a new report out today, the Financial Conduct Authority, the FCA, has shared details of the various ways in which it's working to protect consumers from investment harm. The report features various initiatives designed to stop and disrupt potentially harmful firms and activities within the retail financial services sector. It covers the first 10 months of 2020, during which time many of us felt our personal finances come under increasing pressure because of the COVID-19 pandemic. That's important because scammers like to prey on us when we're feeling vulnerable, when the economy is going through a tough time, and when people are fearful about their jobs, their homes, the stock market. That's when scammers up their activity levels. Scammers are more active because they know that these tough times make us distracted, they make us more vulnerable to their schemes. So during this 10-month period in 2020, the FCA stopped applications for authorization from 343 different financial firms. They stopped these authorization applications where they identified the potential for consumer harm. The stopped authorization applications represented almost 1 in 10 of the applications the FCA received during that period. That's a great start. Without authorization, businesses don't have the perceived credibility with consumers. I think you're far less likely to trust an unregulated business than you are a regulated business. And that's also why I wasn't happy to see the FCA registering crypto asset firms for the purposes of preventing money laundering. Yes, it's a good thing to prevent money laundering, which is sadly a really big feature of the crypto asset sector, but slapping that label registered with the FCA on a crypto asset firm gives it an air of credibility when it's not actually authorized for things like suitability or capital adequacy. You don't get any consumer protection because of that FCA registration, so you do need to still look beyond that FCA logo, I'm sorry to say. In addition, the FCA opened more than 1,500 supervisory cases which involved financial scams or high-risk investments. That's good news, but that is a lot of supervisory cases, and it goes to show just how prevalent the amount of scamming and high-risk investing is out there right now. That prevalence of dodgy dealings is backed up with the next stat. During the first 10 months of 2020, the FCA received more than 24,000 reports of unauthorized investment activity. It also published more than 1,000 consumer alerts. That represented an 82% increase compared to the same period a year earlier. As I mentioned at the top of the video, tough economic conditions are ripe for scammers who prey on uncertainty, who prey on fear. I'm not surprised at all to see an 82% rise in consumer alerts. The big question, I think, is, are consumers aware of these consumer alerts? Are you proactively checking them before you part with your cash? I'll make sure I put a link to the FCA consumer alerts page in the description. In respect of the action taken against firms found to have caused consumer harm, the FCA pursued 47 enforcement investigations against unauthorised businesses last year. 47 investigations out of more than 24,000 reports of unauthorised investment activity. That does not feel like anywhere near enough to me. The FCA secured nearly £6 million to be returned to investors, as well as obtaining court orders to secure a further £14 million for investors, which the FCA is now going to be taking steps to recover from those firms. It's always good to hear about the FCA recovering money on behalf of investors, but again, it feels like a very small amount. One of my regular criticisms about financial services regulation is the lack of any real consequences for the regulator when it fails to act, either decisively enough or quickly enough. That's because consumers ultimately, in most cases, can fall back onto the Financial Services Compensation Scheme, and the Financial Services Compensation Scheme is funded by regulated firms like mine. When the FCA are out there effectively spending other people's money to compensate investors in failed businesses, where is the incentive for them to do any better? The FCA also issued fines of more than £80 million to regulated firms and individuals during 2019 and 2020. What happens to those regulatory fines? Well, since April 2012, the fines have gone to HM Treasury. Some of that money is then donated to charities, mostly military charities. I think military charities are always deserving of our support, but this mechanism of paying regulatory fines to the Treasury, who then donate some of it to charity, is plain nuts. Please keep in mind that these fines are ultimately paid for by the consumers of financial services through the fees and the charges they pay. Instead of donating the fees to charity, the money should go towards funding the Financial Services Compensation Scheme, or it should go towards reducing the regulatory levy, the regulatory fee invoices charged to all regulated firms. If that happened, consumers would ultimately pay less. The FCA then turns to its actions in respect of defined benefit pension transfers. Those have been a subject of regulatory focus in recent years, or at least the suitability of advice around defined benefit pension transfers. The FCA reported that 130 firms stopped providing advice in 2020 as a direct result of action taken by the regulator. The proportion of pension scheme members who are recommended to transfer from their defined benefit pension to a private pension arrangement fell. It fell from an average of 69% in October 2018 down to 57% in March 2020. That's progress for sure, but it still means that nearly 6 in 10 people who speak to an advisor about their defined benefit pension are being advised to move it into a private pension arrangement. The FCA is calling today on regulated financial services businesses to use it or lose it when it comes to their regulatory permissions as a way to reduce the risk of harm to consumers. This call to use it or lose it comes because a business model may evolve over time, so regulatory permissions may no longer be required. The FCA says that outdated or incorrect permissions might give a false impression to consumers about the level of protection offered, or indeed give credibility to unregulated activities. Commenting on the release of this report, Sheldon Mills, who's Executive Director, Consumers and Competition at the FCA, said, "The UK has one of the world's leading financial services industries, offering consumers access to a wide range of investment products. In some areas, however, the consumer investment market is not working as well as it should, and too often consumers are offered unsuitable products or advice. Protecting consumers and ensuring they have confidence in the suitability of advice they receive is a key priority for the FCA, and today's report highlights some of the work we are undertaking to achieve this. Incorrect or out-of-date permissions increase the risk of harm to consumers, as they can mislead consumers about the level of protection offered or give credibility to unregulated activities. This is why we're today calling on firms to review their permissions and ensure they reflect current business models. We will take action where we consider out-of-date permissions may cause harm to consumers. The message is clear: use it or lose it." One more finding from the report before I move on to the 6 red flags to look out for, the 6 red flags that indicate you're being scammed. And that's the news that the FCA is getting tougher on suspicions of phoenixing. I'll explain what that means because it's a bit of financial services jargon. Essentially, phoenixing happens when a firm or advisor is naughty, does something bad, gets run out of town by the regulator or his peers, and then comes back and tries to set up a new business with a fresh authorization and a clean slate. In the past, this has been far too easy. We've seen numerous examples of firms dumping their liabilities onto the Financial Services Compensation Scheme and then starting afresh. In some instances, the individual advisors from a disgraced business set up their own firm, but with a fresh authorization. But it looks like the FCA is finally, and far too late by the way, getting wise to this particular practice. In the first 10 months of 2020, they stopped 12 firms from getting authorization because of these suspicions of phoenixing. In addition to today's report, the FCA has launched the next phase of its Scam Smart investment campaign. The campaign is designed to warn consumers about the increased threat of clone investment fraud. It shares some of the key warning signs and directs investors to the FCA's warning list of firms to avoid. Again, I'll link to that in the description. It says investors should also check the FCA register of authorised firms to check that a business is genuinely authorised and regulated by the regulator. And again, I'll link to that list of authorised firms in the description below. The FCA shared on their Scam Smart pages 6 warning signs, 6 red flags to look out for. If you see any of these, there is a good chance that somebody is scamming you. Number 1 is unexpected contact. Traditionally, scammers cold call, but contacts can also come from other sources, online sources, so emails or social media posts, blogs, word of mouth, or even in person at a seminar or exhibition. Please do keep in mind when thinking about this one that any cold call related to a pension is illegal. If somebody is cold calling you about your pension, they are breaking the law. They are a scammer. Hang up. It's as simple as that. Number 2 is time pressure. They might offer you a bonus or a discount if you invest your money before a set date, or they might say that the opportunity is only available for a short time period. Time pressure is a psychological trick. It's designed to rush you into making a bad decision. Given a bit more time, you would probably be able to engage your brain and realize you were being scammed. But the ticking clock aspect of a scam is designed to stop your rational thinking from taking place. Red flag number 3, social proof. Scammers may share fake reviews and claim other clients have invested or want in on the deal. I see this more or less every time I post a video here on YouTube about investing money. A scammer pops up in the comments, usually with details of their WhatsApp trading signal service, and then several more comments get added underneath, more or less instantly, again from fake YouTube accounts, and they try and lend credibility to the scam. Don't believe everything that you read online. I think Abraham Lincoln said that. Red flag number 4, unrealistic returns. Fraudsters often promise tempting returns that sound too good to be true, such as much better interest rates than you can get elsewhere. However, scammers may also offer realistic returns in order to seem more legitimate. Please keep in mind there is an unbreakable link between risk and reward. If you want sky-high returns from your money, then you need to take sky-high risks just to stand a chance to achieve them. In other words, you could lose all of your money. And we saw last week, didn't we, the FCA remind crypto asset investors, including people who are speculating on Bitcoin, that they could lose all of their money. It's the risk and reward link at work. Red flag number 5, false authority. Using convincing literature and websites, claiming to be regulated, speaking with authority on investment products. Since the world has moved largely online, we see less now in the way of glossy brochures or flashy offices from scammers, but we do see some very convincing looking websites, and we also see lots of fake lifestyles on social media. Again, take it all with a pinch of salt. These scammers are simply trying to build a sense of credibility and make their offer seem more convincing. It takes minutes to knock up a convincing looking investment website, and it takes just seconds to go and stand in front of a supercar and record a social media post. And then red flag number 6, flattery. Building a friendship with you to lull you into a false sense of security. This is another trick from the psychology of influence and persuasion. There's a great book on this by Professor Robert Cialdini. It's called Influence, and it details the psychology of persuasion. All of these little tricks that convince us to do something. When you're aware of them, they're quite easy to spot. But if you're not aware of them, they are incredibly convincing. Scammers know this. Scammers use these psychological tricks to steal your money. 6 red flags there to watch out for. Please, please do be careful out there. Scams are on the rise, especially online scams and those using social media as a platform. Do your homework before you invest your money. Check carefully that the individual and business you're dealing with is legitimate. If you found this video helpful, there is one super quick thing you can do right this second to support my channel. Smash the like button. And if you fancy being an even bigger supporter, why not share this video with your social network or with a friend or family member who you think gets something out of watching it? Who knows, you might even prevent them from being scammed. Press that share button now. Thank you for watching this video. Until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.